Hey wealth creators, Warren Buffett says that investing is crucial to preserving the value of your dollar. For example, between 1890 and 1900, a pound of steak cost about 12 cents. Currently, 12 cents won't even buy you a third of an ounce of steak. Thus, since 1900, the dollar has lost 97% of its value. Buffett calls inflation a cruel tax. You can think of it as an annual tax on any cash you have currently in the bank. Buffett has called The Intelligent Investor, written by Benjamin Graham, the best book about investing ever written. Buffett has said, quote, "Chapters 8 and 20 have been the bedrock of my investing activities for more than 60 years. I suggest that all investors read those chapters and reread those chapters every time the market has been especially strong or weak." Buffett read this book when he was only 19 years old, and these two chapters are considered foundational to investing, and the book is considered a classic book on value investing. Now I have to disclaimer, this is not investment advice, I'm just a smart guy on the internet. The book begins by contrasting investors versus speculators, and says that we should be investors rather than speculators. Investors utilize three things. The first is to use thorough fundamental analysis. The second is to seek safe and steady returns. The third is to protect against loss. The book also says that you need to determine what kind of investor you are. Are you an active, enterprising investor, or are you a passive, defensive investor? The active or enterprising investor will be spending a lot more time going through the balance sheets of individual companies. The passive or defensive investor will have a lot more time on their hands to pursue other activities and are more likely to invest in instruments such as index funds and exchange trade funds. Regardless of which type of investor you are, the book stresses that you're going to have to take your emotions out of your investing decisions. You must be able to know that prices are going to fluctuate, and you are going to have to emotionally endure this without panicking and doing stupid things like selling when stocks go down or are cut in half. Chapter 8 focuses on Mr. Market. It is an allegory for the stock market, comparing the stock market to a crazy uncle that comes to your door every single day offering a price for the business that you own. It stresses that you must think of owning stocks as owning a business and nothing more. Mr. Market, or your crazy uncle, comes to your house every day offering a different price for your business. Sometimes Mr. Market will be in a depressed, negative, or pessimistic mood and offer you a low price for your stock on that particular day. Sometimes Mr. Market can be overly optimistic, almost manic and bipolar, and offer you a very high price on that particular day. The bottom line is that you have to take advantage of high prices and totally ignore the low or wacky prices. You have to ignore your emotions and the current market price and hold to the intrinsic value of the stock. Chapter 8 says don't be overly concerned with price declines when the underlying fundamentals of the business are sound. Mr. Market will always be back no matter what, and no matter how many times you take advantage of him with high inflated prices. It's important to note that Buffett says that some people should not own stocks at all because they get too upset with price fluctuations. Buffett says that if you're going to do dumb things like sell to Mr. Market when the price goes down, you shouldn't own stock at all. For example, if you buy a house for $20,000 and somebody comes by the next day and offers you $15,000, you don't sell it because the quote is $15,000. Buffett says that some people are not emotionally or psychologically fit to own stocks. Buffett does say, however, that more people would be fit to own stocks once you get educated enough on what you're really buying, which is part of a business. You should know that the longer you own a stock, the less risky it becomes, and the longer you own a bond, the longer the maturity, the more risky it becomes. How to invest as a defensive investor. You should diversify. Own a mix of stocks, bonds, and real estate. You should dollar cost average and avoid trying to time the market. An example of this would be make a fixed contribution every week or month into the market. Also regarding diversification, have a mix of different industries. Index funds are a great way to accomplish diversification, and almost all money managers fail to beat the index after taking into account their fees to pick stocks. If you're an enterprising or active investor, you should consider earnings growth. It must be conservatively financed. Have no missed dividends in the last 10 years. Have no earnings deficit in the last 10 years. And you should buy cheap assets, which can be calculated. So how do you actually find cheaply priced stocks? You should find a company priced lower than its net working capital, which can be calculated by assets minus liabilities. To be fair, these are rare today except during bear markets and economic crises. This harkens back to Buffett's old adage, be greedy when others are fearful and fearful when others are greedy. Chapter 20. Insist on a margin of safety. The margin of safety is the difference between the intrinsic value of a business and the price you paid for it. The margin of safety also goes back to the idea of diversification. The more diversified you are, the less vulnerable you are to one single industry that experiences a downturn, and you therefore have a margin of safety in diversification of industry. This harkens back to the old adage, don't put all your eggs in one basket. So how do we find out if the stock market is overvalued or undervalued according to Buffett and Benjamin Graham? A lot of people on YouTube like to quote a formula that neither Graham nor Buffett ever used, and I'm surprised how prolific this misinformation has become all over YouTube. One way to find out if the market is overvalued or undervalued is to use the Buffett indicator, which can be calculated by dividing the total stock market capitalization by the gross domestic product of a country multiplied by 100. If the valuation ratio falls between 50% and 75%, the market can be said to be modestly undervalued. Also, the market may be fairly valued if the ratio falls between 75% and 90%, and modestly overvalued if the ratio falls within the range of 90% and 115%. Let me give you an historical example. Using the Buffett indicator, let's calculate the market cap to US GDP ratio for the quarter ending September 30th, 2017. The total market value of the stock market as measured by the Wilshire 5000 was $26.1 trillion. U.S. real GDP for the third quarter was recorded as $17.2 trillion. The market cap to GDP ratio is therefore $26.1 trillion over $17.2 trillion times 100, which equals 151.7%. In this case, 151% of GDP represents the overall market value, and it indicates that it is overvalued. The current Buffett indicator is just over 150%, which indicates the market is still significantly overvalued. This is in part why Buffett and his investment managers currently seem to prefer cash to stocks. Berkshire Hathaway sold $13 billion of stock in the first quarter while buying less than $3 billion. Berkshire is currently sitting on a cash pile of over $130 billion. At current valuations, Buffett would rather hold short-term T-bills earning 5%. If you want to know where you can park your cash in a short-term CD earning 5.5%, stick around to the end of the video. Warren Buffett has said that this ratio, quote, is probably the best single measure of where valuations stand at any given moment, unquote. So this ratio can be utilized as one way of discovering the margin of safety. The margin of safety is crucial to Buffett's 2 rules of investing. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. In summary, an overvalued company or an overvalued market may be a selling opportunity, and likewise an undervalued company or an undervalued stock market may be a buying opportunity because its stock price is higher or lower than its fundamental value. An example of taking advantage of this principle passively would be buying an index fund more aggressively when there is a market crash or when stocks are priced cheaply based on the intrinsic value of the market by using the Buffett indicator or other indicators I'll get into in future videos, so make sure you subscribe. If you guys enjoyed this video and you'd like to learn where you can park your extra cash and earn a 5.5% APY in a short-term CD, click on this video in the top right-hand corner of your screen, which will also be in a pinned comment below.